All right, so home prices are expected to rise in all markets across Canada next year, as per a bunch of greedy criminal realtors. If you work at Royal LePage, I'm just kidding. I'm not kidding. I'm kidding. Real estate brokerage firm Royal LePage expects home prices to increase 6% annually by the end of 2025, according to its annual market survey forecast released Wednesday, with prices set to climb across all major markets as more buyers come off the sidelines amid lower interest rates. The 2025 survey found that the aggregate price of a home, aggregate is just all types of homes everywhere in that market, calculated using a weighted average of the median value of all housing types, will rise 6% annually by the fourth quarter of 2025 to $856,000. The current aggregate price is estimated to be about $808,000 in the fourth quarter of this year. The report also says that the median price of a detached home is expected to increase 7%. I've been telling you guys about detached homes. I think the price of detached homes is going to go up. That's my personal opinion. Annually by the fourth quarter of 2025 from $841,000 this year to $900K. Condo prices are expected to rise at a more moderate pace, with prices set to increase 3.5% annually over the same time frame from $585,000 to $605,000. The Canadian real estate market has been in a slump since reaching a peak in 2022 as the Bank of Canada rapidly hiked its benchmark interest rate in the wake of soaring inflation. While the central bank has now embarked on a loosening cycle, cutting its benchmark rate in 4 consecutive decisions since June, probably another 50 basis points tomorrow, the lower rates did not immediately bring prospective buyers off the sidelines. Where am I now? Royal LePage says that has started to change, with activity picking up in October, sales up 40% year over year, the same month that the central bank announced a jumbo-sized 50 basis point rate cut. After several years of unusual volatility in the real estate market, key indicators point to a return to stability in 2025. The backlog of willing and able buyers continues to grow. They're talking about demand that hasn't translated to sales, people that want to buy but haven't bought yet. That is like shadow demand, I guess. An upcoming change to the mortgage lending rules will further enhance Canadians' borrowing power, Royal LePage President and Chief Executive Officer Phil Soper said in a news release, noting that the Bank of Canada rate cuts have taken time to influence buyer behavior. The central bank will issue its final interest rate decision of the year on December 11th. That is tomorrow. We saw a marked increase in market activity at the start of the fourth quarter following the Bank of Canada's 50 basis point rate cut. Buyers now believe home prices have hit bottom and are eager to act before competition intensifies. The federal government's mortgage policy changes that go into effect this month are also expected to help spur activity in the housing market. The measures first announced in September include increasing the cap on insured mortgages to $1.5 million, so now you can put less than 20% down, up to $1.5 million. The previous down payment was $300K. Now you only need $125,000 to buy a $1.5 million home, so long as you qualify for the income. But you're probably going to have a lot of multi-generational families putting 4 people on the mortgage to be able to qualify for this, which will reduce the minimum down payment required to purchase a home between $1 million and $1.5 million. Royal LePage notes that this measure will be especially helpful for home buyers in Canada's priciest real estate markets, namely Toronto and Vancouver, where average home prices are above the $1 million mark. Home buyers will also be able to take out 30-year mortgages on new builds. I actually got this wrong in my last video. I thought it was just 30-year AMs on any insured mortgage. It's specifically for new builds. And if they are first-time home buyers as of mid-December, the new rules will likely help drive average home prices higher in 2025. So, this is going to spur demand for pre-sale condos and things like that. I'd say indefinitely. Royal LePage expects home prices will see the strongest quarterly gain in the first quarter of the year, with more moderate increases expected in the second half of 2025. Home prices are also expected to rise across all major markets, including the 2 most expensive markets in the country in the Greater Toronto area. The aggregate price of a home is expected to increase 5% annually from $1.17 million to $1.23 million, while Greater Vancouver is expected to see prices rise 4% annually from $1.22 million to $1.27 million. Quebec City, Edmonton, and Regina are expected to see the biggest aggregate price increases in terms of percentage, although the benchmark in all 3 of these cities remains below $500,000. The aggregate price of a home in Quebec City is expected to rise 11% annually in the fourth quarter of next year to $442,000. Both Edmonton and Regina see aggregate price gains rise nearly 9% annually over the same period to $494,000. So, my thoughts on this. We don't know what's going to happen, right? There's a lot of bad things. There's a lot of bad data. Unemployment, credit card debt is at all-time highs. Every day there's some new catastrophic fear coming into the market. What I will say is this. First off, I'm going to show you guys this. This is the S&P, right? We're up 31% in the last year. 31%. The average annual gains of the S&P index historically is like 8 to 12%. So this is like 3 years of gains in 1 year, basically. Vancouver this market specifically, no longer trades on fundamentals. Home prices do not rise in correlation with median incomes. They rise based on the wealth of the people buying here. So people that have cash, people that have money, people that have wealth buy real estate here. And if you're putting 500 grand down on an $800,000 home, well, the price to income ratio doesn't really matter anymore. You can make 60 grand a year and buy an $800,000 home, right? So what ends up happening, as an example, right? We're up 31% in the S&P. We're up 128% in Bitcoin. And we're up, roughly 30% in gold, right? So what could happen here is, let's just say these markets start selling off early next year, which I think is going to happen. I don't know, but I think that is a possibility. When markets sell off, that money doesn't just like disappear into thin air. It doesn't just like go away. That money that people take profits on, they sell out of the asset, will then get rotated into another asset, whether it's cash, GIC, real estate, gold, possibly a different sector within the stock market. It gets rotated into something else. So right now we're in a situation where we're going into next year with lower prices, lower interest rates, lower down payments, and longer amortizations. And on top of all of that, you have every financial market other than real estate trading at all-time highs. So it wouldn't be far-fetched to say that people take profits in these markets and move that capital back into the real estate market. Now, I'm not saying prices are going to go up. The greedy realtors are saying this. Just kidding. What I am saying is that I think it is a plausible report that prices could go up. And all of these bad things that we're talking about, unemployment, credit card debt, government debt, these things could take longer to play out than 2025, in which case you would see prices rise in 2025 and then possibly come down in 2026, right? We don't know. But for the foreseeable future, the next 6 months, real estate is looking pretty bullish right now. It does look like the prices are going to go up. And I may be wrong on that. But I mean, like I said, you have like the affordability of real estate has drastically, the unaffordability has drastically come down in the last couple months, right? With the interest rates, with all the new programs they're launching. I was talking to my broker the other day. He says that these extended amortizations basically equate to an extra $50,000 to $60,000 in purchasing power. So if you're a first-time buyer and you're only getting approved for $450,000, well, now you can buy a home for $500,000, $510,000 just because of the new mortgage rules. And that's not even counting in the interest rates that have also come down, because I think the bond market actually came down as well in the last couple of weeks. So, you add in the fact that maybe you can secure a cheaper fixed rate these days. Maybe you can, you get the 30-year AM, you're potentially qualifying for $60,000, $70,000, $80,000 more than you would have, 6 months ago. So although this report is done by Royal LePage and we must discredit everything they say just because they're realtors and they benefit from home prices going up supposedly, I do think it's feasible that their report ends up being somewhat correct. Now, it could completely go the other way and maybe unemployment just spikes to the upside in the next couple months. And then with all the negative media coming out, market sentiment basically crashes and then, home prices go down next year. That's completely possible too. All I'm saying is don't discredit this report because there is data, there is facts to back it up that home prices could go up next year. Now, I have a newsletter where I go over market insights and handpicked deals. You can join that using the link below. If you want to chat about buying or selling, call me on my cellular. I'm that Agent Kelly. I'm making moves to move you. Peace.